So our agenda is a gold rally. All of us are mesmerized by this gold rush, what we have seen in last 1 year or so, maybe accelerated in last 3 months, 6 months, but for last 1 year or so. So our agenda is what is gold rally about? So this is a four-legged, four-pillar, which on what this gold rally is resting on, and I will take you through these four pillars in detail. So the first one is the money printing by the central bank, the gold demand and supply dynamics, the role of China, which during my research I got to know about the role of China in the gold price movement, and finally it is the influence of the real negative interest rate which has influenced the gold prices for so long, and that would also answer you that how long and how far. Okay. So let's start with this chart. Our evening with this chart is there's unprecedented expansion in the central bank balance sheet. And what does it mean? You have heard about the money printing, and that's one of the most talked about word in the last few months or so, in the post-COVID world. But let's put a tangible value to this. Is that the Federal Reserve balance sheet has expanded 7 times in the last 10 years, and I'm just looking at a log scale of 10 years. So close to 7.15 trillion US dollar. And if I have to add up the four biggest central banks of the world, the Federal Reserve, Bank of England, Bank of Japan, and the ECB, the total balance sheet size has increased by 5 trillion US dollar, which is close to 45% expansion in last 6 months or so. And that explains the magnitude of the balance sheet expansion which has happened. And balance sheet expansion is, for a layman terms, it's the money in the economy. Whether it goes into real economy or it goes into the financial economy is a separate issue, but that is the money in the economy which has been printed by the central bank to fight the COVID situation, unprecedented COVID situation. To give you another idea, interesting idea, is that what does it mean for gold? So if you look at in history of last 15 years or so, the gold reserves as the percentage of the Federal Reserve balance sheet used to be close to 15% and went all the way to 25% before the great financial crisis. And they are today just 6%, less than 6%, as a percentage of the central bank balance sheet. So the balance sheet of the central banks today are not backed by the gold. And that is one of the most important pillar. In 1971, 15th August, that's an interesting date, we share Indian shares with the rest of the world. That was the day when the gold peg was removed from the US dollar, and the US dollar became a non-gold convertible currency. And since then, we have seen a huge expansion in the monetary side in the global financial markets. I mean to say in the central bank's balance sheet. So that gives you an extent of the magnitude of the problem in the process. This is an interesting one. What does a central bank expansion does it to the currency? So US dollar has started declining for last 4 months or so, 3.5, 4 months or so. And coincidentally, a US dollar also follows a 12-year cycle, 12 or 13 or maybe 11 or 13-year cycle. But let's take an average. It's a 12-year cycle where a dollar sees an up cycle and dollar sees a down cycle. So this is a chart from 1971 onwards, which gives you an indication that how dollar cycles have played out. And I will come to you in a subsequent slide that what does it mean for the gold prices. But it is very important for you to understand that dollar follows a cycle, and these cycles are a 12-year cycles. And now we are in a declining cycle. We have started a declining cycle, which could continue for next maybe 3 years to half a decade or so. So in that context, it is very important to understand that where is the dollar position, and one of the reason for the dollar cycle is the expansion in the central bank balance sheet, unprecedented expansion in the central bank, U.S. central bank balance sheet. And why dollar is important? Because U.S. is the world reserve currency. 80% of the global trade takes place in the U.S. dollar, and 52% of the global reserves are in the US dollar. So dollar is an alternative to gold. And that's the reason declining dollar cycles or an up cycle does influences the gold prices significantly. And this is the chart which says you that dollar has an inverse relationship to the gold price cycle. And what we have seen since the market got a whiff of the declining dollar cycle in the last some time frame, and that's the reason you can see that how the gold prices have started behaving up, and they have accelerated in the last 4 months or so. So this is one of the most important pillar, talks about that how dollar influences the gold prices, and which is very important because gold is not something which I and you buy can influence the prices. It's the global monetary order, global monetary cycle, central bank balance sheets, and host of other things which influences the gold prices. So the thing to note here is that a declining dollar cycle has an inverse relationship to the gold prices. With this, I come to the next point on the next agenda here, is how is the gold demand and supply. A lot of people do make a comment, it's a commodity, it's a yellow metal, it's a shining commodity. So let's see the demand and supply. So usually any other commodity like iron ore or coal would see a huge expansion in the supply side, but as one of the most sought after commodity or sought after metal, gold has not seen any significant expansion in the last 10 years in a row. This slide talks you about that how the supply increase in the gold in the last 9 years or 10 years time frame has been just a meager 1%, just 1%, while many other commodities have seen a significant supply side addition over a period of time. But if you look at a gold as a supply situation is just a 1%. So this I can conclude here is that it's a commodity which is in very short supply. It's in a short supply, and in a situation when the global monetary disorder has taken place, a commodity in a short supply is a commodity which is valuable, if you have to call it a commodity by any chance. This is an interesting table. I did pick it up for you. Is that a lot of people do ask about is a lot of people who are in business do make this observation that the jewelry sales have been declining for some time, and this does influence the gold prices. Answer is yes. But what has changed in the last 15 years or 10 years time frame, and if you look at over a period of cycles and the blocks, is that the demand for gold bars and gold coins have replaced the demand for jewelry. The demand of financial product as a gold has changed the nature of the consumption of the gold. So earlier it was the jewelry, maybe in our mother's time it was a jewelry, when now in our time, in the millennials time, it is the demand of the financial product which is making sure that the gold find its place. So people don't want to use as only jewelry as a proxy and a medium. So if you look at this chart, and if you look at this part of the table, it says that the demand for the jewelry has been taken over by the demand, has been substituted by the demand of bar, coins, and the exchange traded fund, which owns gold in the process. So that gives you an idea that the gold demand is very much there, but the form of the gold demand has changed. And since we are talking about the demand of the gold, this is very important. One of the biggest buyers of the gold in the world are the central bankers, the Bank of Japan, the Bank of US, the Federal Reserve, the Bank of Germany, the Bank of England, and many so on and so forth. And if you look at the gold purchases by the central banks for the last 2000 to 2009, we have seen sale of the gold by the central banks. And from 2010 onwards, we have seen a complete reversal of situation of the gold by the central bankers, and which means that in 2019, we have one of the highest purchases by the central bankers, and cumulatively it's significantly high. So what does this tells you from the purchase and from the demand point of view is that there is a demand, a significant demand, and now central bank owns close to 35,000 metric tons of gold in the process, and which is one of the highest in this recent times. And also look at it from a perspective of what are the alternatives to the gold for any of the central bank. It's the US Treasury. And today the yield on the US Treasury, the competing product to the gold, is the lowest in the history, 55 basis point, 50 basis point, and it has been coming down. And that's the reason you have seen a huge bond rallies for some time or so. So what does it indicate you is today is that the sovereign credit risks some kind of risk to the portfolios. And there is only one alternative for the central banks, either to find another round of sovereign securities looking across the globe, or to find gold as an alternative. And people will choose what is more convenient to them and what they have believed and what has held as a trust and belief for years and years together. This chart tells you about the change in the gold demand in the last 2 years, and I just made a point that the decline in the jewelry has been made up by the central bank buyings and the ETF buyings. So the gold demand has remained the same or maybe slightly inched up, but it has not disappeared by any chance in the process. I come to another interesting aspect is the production. The gold production has seen a decline in 2019, and we have just seen an increase of close to less than 1% on the annual rate in the last 3 years. So the point I'm making here is the production has not caught up, the demand has remained same, and there's a huge potential demand environment by the various central banks, which is there, and by the other participants. So you have a perfect situation where a gold demand and supply remains very tight by any sequence. Why this is important: in most of the other commodities, we have a situation where the rise in the prices do meet up with the increase in the supply, and which is not the case in the case of the gold. The supply increase is not happening at the pace where the price increase is happening, and nor do I see a chance where the supply increase can happen. In the last 15 years, there has been no new mine of 50 million ounce, which is a sizable mine by the gold standards, has been found, or maybe no 30 million ounce deposit has been found in the gold, in the gold, and only few 15 million ounce deposits have been found. So what we are making a case here is that this is a very strong pillar where the demand for the gold is there and the supply is not keeping up pace in any chance by any case. And this is some slides I did pick up for you in terms of that the production reserves have gone down substantially in the last couple of years. And this was also in my previous slide, that there's no new supply which has come in, no new discovery which has happened of the gold. And what has happened is depleting resources and depleting resources. So we have seen a situation where the world was worried about that the world will run out of oil. I'm sure at some point of time world may run out of gold, which looks far more a proposition versus a world running out of an oil. What this is a very interesting is that usually the financial investors do move in looking gold as an alternative whenever the price rise happens, and which is a momentum. And if you look at somewhere in 2010 and 12, you saw a huge upsurge in the prices of the gold, and as well as in the exchange, financial flows through the exchange. And in the subsequent 6 and 7 years, we saw a decline in the prices and decline in the financial investments by the financial investors. And now we are seeing the reverse of situation. As the price moves up, the more financial investors converts their assets into the various other forms into a gold. So this is a completely, as the gold prices goes up, more money chases the gold in the process. I come to the third leg of our, third pillar of our gold price movement, a very strong pillar, is so what has been the role of China in this gold price movement? It has been very less talked about, but it throws some very interesting analysis, the role of China. If you look at it, the share of China in gold demand was close to 10% in 2000 in gold jewelry. Today in 2019, it is 36%, significant, of the total demand in the world, of the total jewelry demand in the world. If you look at the share of China in bars and coins in 2000 year was 5%, today it is 28%. The share of ETF, which is just called the fancy in China, the gold ETF, which used to be 0.5% in year 2010, has gone to 3% in 2019 as a percentage of total ETFs. And if you look at on overall the consumption, overall consumption, it is 10% on 2000 has gone to 33%. So this is a marked change which has happened in the way China sees the gold as an alternative to their assets, and they have just caught up to the fancy of investments in gold, which was not a culturally the way India was over a period of time. But India, in terms of the jewelry demand, has given its way to China. Look at this chart, which says that China used to have consumed demand close to 676 tons in 2010, and it has taken over. And while India was 1,000 tons, And 2019, the roles have reversed, and China is close to 900 tons, while India is 690 tons. So we all get married to idea that it's a culturally India has looked at a gold as an investment, but this reminds us, all of us, that it's a China which has started looking at gold as an investment, and it's a big tactical shift in the process. This chart gives you an idea about the gold production, which has China has used its technological prowessness to increase the gold production. And if you look at this gold production in the below table, it used to be 225 ton in 2005, and this in 2019, that's the latest available calendar year data, it is 420 tons. So they have matched up with the demand side, also with the production side in the world. And so they don't want the gold to go out of China, which is very, very important for us to know. And today they are consuming close to maybe 1,000 tons, and close to 65% is imported from the world part of, from the overall part of the world, and 33 is indigenously produced in the process. This comes, this I bring you a very interesting thesis, is that is Chinese currency managed against gold versus a US dollar? For years and years together, Chinese currency was is still a peg against a US dollar, and they keep on adjusting the peg against the US dollar. But what I see now in last year or so, maybe year and a half or so, is that Chinese currency has become less volatile and is moving in a direction in the way the gold is moving. This has a lot of geopolitical significance, that if China is able to manage a currency which has got a volatility which is closer to the gold and which runs closer to the gold, then you have a lot more people who will believe in the Chinese currency, and that fits into their geopolitical ambition of replacing US dollar in next decade or so as one of the favored currency in the world. And what does it mean is that huge demand of the gold, because what does it mean in a plain simple language is that you exchange your renminbi against a fixed parity of a gold. Has it happened now? Answer is no. Can this happen in next a year or so? Answer is yes. At some point of time, answer is yes. I do see that happening, but at least the sign is there in front of us to wake up to this new reality that the Chinese currency is getting managed against the gold. And maybe when you go back home, you should see this data far more clearly in the next year or so time frame. So with this, we conclude that what are the demand and supply of the gold as a dynamics, the money printing, how it has helped, how the dollar has helped, and the role of China in the gold price movement, the fundamental drivers. Now I come to most interesting part of what our presentation today is, the influence of the real interest rate scenario on the gold. And that will also explain to many of you that how the gold and why the gold has moved up in the last one and a half year or so. So look at this chart. The gold has a performance completely corollary antithesis to the negative interest rate in the environment in the world. What does a real negative interest rate environment means to all of us is when the inflation is significantly higher than the treasury yields, what you can earn, a risk-free to a risk-free asset, a risk-free liability. So you see a situation where it has happened on a couple of occasions in the world. In 1974, where the gold prices shot up and you saw a negative interest rate. This is a US negative interest rate. Then in 1979 also we saw that, and we saw a huge movement in the gold prices. In the last 2 decades, we have seen the inflation systematically coming down because of the globalization. And as the interest rate benign interest rate happened, we have seen the movement in the gold. And the gold movement of 2010 and 12 was also marked because of the real interest rate going negative. And now we see situation again coming back in the last 3 months or time frame or so, where the treasury yield has crashed and you are seeing a real negative interest rate environment and the movement of the gold price. Nothing explains better the movement of the gold prices versus the real negative interest rate environment. This is one of the most interesting table I have come across and I wanted to present to you all, is that look at the periods of the negative real interest rate. And let's take United States as a proxy, because dollar is a currency which everyone would weigh as an alternative to a gold or maybe any other gold standard currencies in the world. And look at, there are 5 instances: 1973 to 75, 78 to 80, 2007 to 2008, and then 2011 and 12, and to August 2019 onwards to July 2020. These are the time frames when we have seen the negative real interest rate in United States of America. And the duration is also that sometime it was duration for 23 months, 24 months, and then 10 months, 19 months, and now it's been close to 12 months. Where on a break-even level, now we are moving to a negative interest rate scenario. And what is the return of the gold during this period? So if you were able to predict a negative interest rate scenario 6 months ahead of the cycle and the timelines what we have discussed here, and you held it to the 6 months after the negative real interest rate even turned positive, you made 52% return in the gold during that time frame. During those 23 months, 6 months add here, and 6 months you add here. So this is like 6 and 6, another maybe 34 months or time frame. And look at the situation in October 2078 to 80, you made 183% return in a gold in those period of 24 months and another 12 months or so. Add up another 12 months, 6 months before and 6 months ahead, and so forth and so case. And that explains you the gold price movement in 2019 to 2020, that we have started hitting the negative interest rate in last 6 months or so, 4-5 months. And increasingly market is getting convinced that because of the huge budget deficits in the global environment, when in the post-COVID situation, the governments are struggling with the revenues and they are seeing a huge budget deficit. We are going to see a negative interest rate cycle for a long period of time. And in that case, the gold is the asset to own for some time, or for maybe how long and how far is getting answered here. The gold will do well till the negative interest rate scenario will remain, and you can add a 6 months time frame more. And if you see a positive interest rate cycle by time frame where the interest rate cycle or the inflation has to collapse or the interest rate cycle has to go up substantially in the major economy like United States of America, then you will see the rally will stop, or maybe you will see some decline in the gold prices. And this is a time you look at another table, subsequent table, after the period of negative interest rate, when the inflation, either reason inflation fell or because the interest rate were increased, the gold prices went down by 20%, and exception being one on 16% up. And then it fell down after some time, and then another 15% down in 2012 to 2013. So this becomes one of the most important chart for you to reconcile that how long this rally will and how far is it. Can anyone would be in a position to predict that where the gold prices will go on? Answer is no. But answer is yes, that directionally the gold prices will remain significantly at elevated levels, and more the possibility or the probability of going higher from here, significantly higher from here, is high till the negative interest rate scenario remains. And I am of a firm belief that this will remain for considerable period of time. I don't see a situation where the interest rate cycle can change. In fact, I see a situation where the inflation, because of the monetary printing, what has happened unprecedented, can come back again in a significant way, which is at the moment as 1.2% or so, and it can be a significantly higher. Then you may see further acceleration in the gold prices. This is an interesting chart, is when in month of March, suddenly you saw a huge downward spike in the gold prices. And as I explained to you in my previous two charts, that why this the decline in the gold prices happened is completely because of the expectation that the real interest rate is going up and it is not going down. And in the month of March, you saw a decline in the gold prices, and it just remained for 10 days or so. And then the situation changed dramatically as the COVID progressed, as the response of the government progressed to the COVID, and it changed significantly. Gold has outperformed all the currencies. Very few currencies can stand against gold. This is a 20-year chart. If you put this against most of the currencies in the world, gold in dollar terms have outperformed each and every currencies in the system. And that is how the gold has outperformed all the major asset classes in the last 20 years. Whether you are talking about, if you're an Indian investor, you are talking about BSE Sensex or XYZ, and in some form or others, gold has done very well in the process. We at Avalum has looked at a gold, investing in a gold, and on 2 occasions we did spoke about investing in gold in 2018, 19, and 2019 and 20. And for some of you who are more interested in this, can go on our website and maybe look at the shareholder letters in detail. And with this, I conclude our conversation today. As in a summary, the world is awash with money, an unprecedented amount of money, and the world is looking for an assets which is in short supply. Apart from a gold, a case for the paintings of the Leonardo da Vinci can be also be made, or any of the paintings which is in short supply and which will not lose its value, it can also be made. But yes, the world is looking for in abundance, where the money is in abundance. World is looking for an asset which is in short supply. Gold is an order decline in dollar, and central banks are full with the US dollar, the RBI, and at some point of time they need to make a tactical allocation to the assets which is completely antithesis to the US dollar. And as I said during the course of our conversation, in the times of the real interest rate, this is the most important point, negative interest rate, the gold which the reason is the gold has a carry cost. So, and the carry cost is also the treasury yield. So it competes with the US treasury yield as an asset class. And if you have the situation, and if this situation has to reverse where the carry cost has gone negative and the treasury yields are significantly lower than the inflation which is running in the economy, then you have a gold which ideally should do better. And it is for years and years together, it has preserved the purchasing power of money in the decades and decades and centuries to come. And that's what has come back again today as one of the golden moments, as we all say, and Goldilocks moments for the gold. Thank you. With this, I end my conversation and my short presentation, and I hope I was able to make to justice to the discomfort you had in the start of our conversation. At a
Thank you.
Thank you.
Thank you. Thank you, Manish. Now I would